Thank you, everyone. My name is Gordon Winston. In addition to being a partner with Round 2 Capital, which is a emerging, I'd call it European-centric private credit plus strategy, I was a former partner of a company called DRI Capital, which we began at one point back in 2002 as a private office. We had an exit event, and from some of the capital, we actually ended up involved in a possible takeover of a publicly traded company to a family office. Spent $100 million, took the company private, and then transformed it into a $5 billion asset management platform focused on the acquisition of royalties in the pharmaceutical space, or more interestingly, intellectual property. I got involved in investing in this area after identifying some off-balance sheet interests. I'm a former Wall Street guy. I spent 15 years between Lehman Brothers, Peter Peabody, and Bear Stearns. And then post moving on from the royalty space, I launched a structured finance fund with a partner named Christian Cernich, who is now building out Round 2 with myself.
Brian, what's your...
Sure. My name is Brian Walter. I'm co-founder of Fairbridge Asset Management. One of the topics that came up during the lunch was access to capital. I run a bridge lending fund where we lend, generally bridge to something, bridge to traditional financing, bridge to a sale, bridge to a takeout. We do a lot of pre-development loans, construction loans, as well as adaptive reuse loans. So we are some of the capital behind some of the transformations of different areas throughout the country. Most of our loans have been east of the Mississippi. Heretofore, we are starting to expand across the country. We do like to visit and meet each of our lenders or borrowers and visit every site. So during COVID, as you could imagine, that was a little bit tough. So we had to keep it within driving distance. But now that travel's much more open, we are expanding across the country. Access to capital, if you look at some of the statistics over the last 15 years, the banks have really, since the 08-09 financial crisis, backed away from many, many aspects of the lending market, as we heard about during lunch today. We tend to lend against the value of an asset. We look less at credit scores, although it is something that we certainly keep in mind. We do want to get paid back, but we're generally lending against the assets that are our collateral, rather than against cash flow, which most banks look at. So we are actively growing the fund and looking for opportunities to do that.
So Neil, just by way of introduction.
Neil Gupta, based in Washington, D.C. My company's out of New York City, near Bryant Park. I'm more from the family office side of things. My family siblings and I really founded a company, IT company, which we scaled to 5,000 people and sold, and started investing in startups after that. Coast to coast, quickly found we were better operators than investors. One common pain point we saw in the tech world was access to resources and capital, and we felt we could help address both those in a more differentiated manner than just being another angel investor. So we developed this model over, took us 5-6 years to get to scale, but we developed this model of basically building technology for equity in startups. So we have equity now in 500 companies, and planning to scale this to about 1,000 companies coast to coast. We have events, 100 events a year, where we connect VCs, family offices, high net worth individuals with startups. So investors are looking for good direct deals and deal flow. They can lean on us for diligence. Startups are looking for access to capital. We're also big supporters of, you remember the statistics Andrea shared of African American women, minority founders. We're big supporters of them. 25% of our portfolio have women founders. I think about 60 companies have African American founders, and probably 100 have minority founders. So we have specific events to connect investors to these startups and invest in these startups as well in a big way. And we've somewhat globalized the model in terms of working with startups around the world, but all of our investments are virtually, pretty much here in the U.S., coast to coast.
So again, the theme is what scares and excites you. So for all three of your fields, why don't you kick it off, Gordon?
So I didn't have a really chance to explain the portfolio construction, but we've over the course of the last 2.5 years, we've invested in excess of 50 companies. Transactions that we typically look at are usually, we use structured credit as a way to step into the capital stack of a company. We use this form of royalty finance where we're purchasing a percentage of the revenues, and then opportunistically we're looking for ways to invest growth equity. The companies we've invested in eight different countries. We've had no defaults in the portfolio, and the way that the investment model works is that we're generally looking for somewhere between a 25 and a 35% cash-on-cash return. We're industry agnostic. We're looking at businesses that actually have a very significant component of the revenues derived from software, and we'll cover, any industry that actually those characteristics are demonstrated. Interestingly, in the portfolio, while the world seems to be upturned, we've had no defaults. In fact, the way that we've structured these deals are that we're receiving a percentage of the company's revenues, and we've seen none of that change as a result of the instability in the markets.
But what does scare you? What is your team scared about now?
Well, we're scared about the continuance of, these companies, if you will. You've always got to be concerned about whether or not management businesses can continue to remain stable or continue to grow. The feedback that we're receiving is that there hasn't been any change, and because we see cash flows on a monthly basis, we'd actually I think that we'd have a leading indicator to see whether broadly across these different industry categories we have problems. But of course, that would generally be a problem that anyone would have owning a portfolio of companies.
You're in what I call beer drinking Europe, right? So beer drinking Europe, SaaS companies are still going strong.
Absolutely.
Okay.
Thank you, Mark.
Brian, what scares you?
Not so sure it scares me, but what frustrates me and what I see happen with a lot of projects that we look at is time. Time kills a lot of development. The reason it kills a lot of development is because of the costs of financing that development. All right, I've seen many a good project that should produce a nice return to the developer have that equity return wiped out because it took an extra 6 months or 12 months, and the financing costs ate up their equity return. And where does that delay come from? And what is frustrating is a lot of the regulations, a lot of the local regulations, a lot of the planning and zoning hurdles that need to be jumped over by a lot of developers. I see a lot of, not that those things aren't necessary, but I think streamlining them could create a lot more development. I see a lot of good ideas. A lot of energetic people come to our door looking for financing, but getting through a lot of the zoning and planning and regulations, makes the project untenable. A lot of things they haven't maybe thought about.
Well, I hate to take any guesses on the macroeconomic situation, but capital markets closing up. We have half a dozen companies which are positioned for IPO the next couple of years. So if there's a pullback there, that would be a concern. Obviously, these are strong enough companies that they can ride it out. But if we see a slowdown for 5-6 years, we would that could definitely impact exits for investors.
What's the most exciting thing? What makes you get up and say, I'm excited about the day as an investor?
On my end, the excitement is actually seeing projects work their way through the pipeline to success. As one of my partners likes to tell the story, one of the best days of his career was building a charter school in Brooklyn, New York, and going to the first day of school, seeing that project from planning all the way to development to opening, and seeing the kids' faces when they walked in there. We love adaptive reuse projects. We have a couple of investments down in New Orleans where things are being redeveloped, and we have one of our largest borrowers is in Patterson, New Jersey. He's literally transforming the city block by block by block. You can drive down a block and see which properties are his and which properties are not, because he's literally transforming the city block by block. So
Charles Way, the ex-New York Giants,
I do.
he's got some projects in Patterson.
Yep.
What excites you the most?
Well, I mean, even in the last couple of recessions, we've seen innovation really boom. So, I'm excited about innovation continuing with Web 3.0. We're building capabilities around that. We're trying to get more portfolio companies in, NFT, blockchain, crypto space. So that whole burgeoning area, I've been quite a slow adopter of it myself. But it's the future, and it's exciting to see the developments in the Web 3.0.
So since we don't have our friend Chris from Allstate and Steven, I think we're just going to give him a pass. He did a big one today. He just got out of vacation. He did his thing today. But VJ, I don't see him. So just about the room, things that excite or scare you across asset classes. Peter, you gotta hold on. Stand up.
Hi guys, really nice job. The Fed is poised to raise rates. Personally, I don't think they're going to raise them as much as what the media is kind of anticipating. But Brian, how does that affect your underwriting and your portfolio? And Gordon, I know you're revenue based, so I'm not sure it's a relevant scenario, but I'd like to hear your viewpoint anyway on that. And the same with Gupta. Excuse me.
For us, rates in real estate are having a couple of effects. I mean, first, from our lending standpoint, most of our loans are fairly short-term in nature. So, for instance, during COVID, we were able to increase our average coupon in our portfolio by about 150 basis points in 9 months, given our loans are mostly 12 to 18-month loans. So from that standpoint, I like our product in this environment, in this potentially rising rate environment. From the flip side, in terms of loan to value in our world, the big discussion in real estate is cap rates and what's going to happen with cap rates as interest rates rise. I think we're seeing people try and be conservative and back them up 25 to 50 basis points to be conservative in their valuations on properties. But the counterbalance to that is obviously rental rates have been continuing to increase on the other side. And there's also a lot, I was just at a conference last week on a panel, and the other piece is there is a lot of capital that continues to need to be put to work in the equity side of the real estate market, and a lot of funds that continue to buy up completed assets, a lot of REITs, and so that in our estimations will put a little bit of a cap on cap rates.
So, Peter, thanks for the question. For the way that our transactions are structured is that we're receiving a percentage of the revenues company. So there's a natural hedge or price inflationary hedge that's built into it. From a return perspective, that bodes well for us. If the pricing is passed on to the customer unanticipated in an unanticipated fashion, that also works. That does work to our benefit as well. Because we're still, we're predominantly focused in European-based companies. We're not seeing any, obviously, we don't have currency fluctuation, but as the euro weakens versus the dollar, because we're currently out there looking for incremental financing to build out the funding, we see that there's a natural arbitrage in the portfolio. Thanks.
Yeah, I don't think there's a huge impact in the startup world, frankly. They take equity funding, which is pretty expensive as it is. You know, half-point move in the rates isn't going to affect them too much, other than maybe, you know, some of them are really early stage taking angel money, maybe less angels because, you know, they can't get money out of their house, I'm not sure.
Well, the venture world had a big reset, right?
Yeah.
You want to maybe comment on that, like your observations?
Yeah, I mean, there's a big move in venture, really, from family offices, especially, and high net worth individuals, just moving towards direct deals. Obviously, they still do a lot of their LPs and a lot of funds, but you know, they're looking more and more for direct deals and finding ways to get those, just to save on fees and carry and that sort of thing. So, and due to this, you know, startups are taking a longer time to go public. If you look at Uber and Airbnb, you know, 20 years ago or even 10 years ago, they might have gone public in 4 or 5 years of founding. Now they're taking their time. They're taking 10 years to go public because they have access to billions of dollars of private capital. And so they're not being pushed by funds to go public because the funds really aren't in control of the cap table or the board.
Any other questions, comments? Usually have a geography panel. Where are we scared and excited to put money?
Well, I was going to ask. On the bridge loans. You do anything abroad? U.S., even some countries in Latin America, for example, that are dollarized. Panama, El Salvador.
Yeah, we have not. The furthest afield we've gone is we looked at doing a loan in Bermuda. It's not so much from you know, being concerned about any particular area. You know, everybody needs places to live, you know, and it generally is in short supply in most parts of the world. But it's the legal framework of every single place and the regulatory framework of every single place. Just for instance, we happen to come across a loan opportunity in Bermuda, and apparently to have a first lien on collateral in Bermuda, you need to have a special license, which was going to cost us $40,000 to get. So there went that opportunity. And, you know, it's also the legal framework of any particular country. And it's more about us learning that framework, right? And that getting up to speed on how to protect ourselves if we need to take back our collateral, and what that process looks like. Even in the United States, every state is different. In New York, every borough is different. Certain boroughs you can get collateral back in 12 months. In Manhattan, it's going to take you 3 years. So, and then obviously this, you know, judicial versus non-judicial states throughout the country. You know, there's certain states I can get collateral back in 6 months, 3 months, and you know, we've had one, and obviously COVID has dragged it on, that we're foreclosing on, that, you know, been in the works for 2.5 years. So it's learning that framework overseas. That's a steep learning curve. So right now for us, plenty of opportunity in the United States.
Come join our 361 Firm community of investors and thought leaders. We have a lot of events created by the community as we collaborate on investments and philanthropic interests. Join us.